This is Patrick MontesDeOca with the weekend podcast for May 29, 2021. Is gold setting up a bull trap? Summary. U.S. weekly jobless claims fell significantly last week. The number of Americans filing new claims fell more than expected last week. Experts attribute this decline in part to the easing of pandemic restrictions with the increasing number of Americans now vaccinated. The relief packages are also contributing to a tight labor market as some Americans prefer to stay home with government support than to return to work even as businesses reopen. Looking for a portfolio of ideas like this one, members of Mean Reversion Trading get exclusive access to our model portfolio by reaching out to seekingalpha.com. Fundamentals. U.S. weekly jobless claims fell significantly last week. The number of Americans filing new claims fell more than expected last week. Experts attribute this decline in part to the easing of pandemic restrictions with the increasing number of Americans now vaccinated. The relief packages are also contributing to a tight labor market as some Americans prefer to stay home with government support than to return to work even as businesses reopen and clamor to hire new employees. 23 states have announced they will end the federally supported $300 subsidy to the unemployed starting next month, which some may say discourage the unemployed from seeking work. The 10-year note is slightly higher than this week at 161. We may be establishing a trading range between 146 and about 152 to about 177. Interest rates are going to play a critical role in the next few months as we accelerate into the third and fourth quarters of this year, when we will see a lot of volatility. Most experts believe that higher interest rates will be bearish for gold. In this case, with interest rates where they are, basically in negative territory, if you factor in inflation, we believe that higher rates may be bullish for gold and precious metals. We are already seeing price inflation in commodity futures. More money is coming into the economy, and there are shortages of plastics, computer chips, and many other products. We will probably see a spike in prices as the summer arrives. Real estate prices are also spiking, as is the stock market. Only gold and silver are not making new highs. It is frustrating for precious metals traders. We will see an adjustment, but right now, there are too many bulls out there. The sentiment is extremely bullish and the fundamentals are also extremely bullish. The massive printing of US dollars and other currencies should drive the price of precious metals up as the purchasing power of fiat currencies declines and the velocity of money increases. The leader in volatility is Coinbase. We have been recommending it, but it is extremely volatile given the rhetoric that is out there. It is setting up the standard for the rest of the markets, such as for equities and metals in terms of what volatility can do. The fact that we are seeing such volatility in virtual currency markets means that it is pulling in the other markets to also be extremely volatile. Coinbase has been falling from 429.54 to 208 just since April. This appears to be a perfect confirmation of a weekly reversal. The demand in virtual currencies is not going away. Many people do not want to hold dollars. They would rather hold Bitcoin or coin. Coin appears to be moving back up, so continue to hold it if you have it. We trade the Grayscale Bitcoin Investment Trust, GBTC, if you want to hold it. If you have to be willing to take a 50% correction. We do not believe that this is the way to create wealth. We trade GBTC aggressively to take advantage of the volatility, but we do not hold it long term. It has become a more tradable market. The volume has increased, but it is still very small compared to the gold market. Precious metals. In silver, we are below the weekly VCPMI average of 2794. When we wrote this report, and the daily average of 2793. This is a critical harmonic relationship to identify the price momentum of the market. We focus on mean reversion trading to identify what the market is at when the market is at its mean, which is when we do not trade the market. At the mean, markets go up and down. We trade when markets reach extremes above or below the mean. When the market is at an extreme, there is a much higher probability that the market will revert back to the mean. For gold, we have a weekly bullish trigger, and the target was completed of 1871, which is the weekly average price. By closing above it, it activated a bullish trend momentum. Nugget was down about 96, JNUG down about 111, GDX is slightly down, so gold and its derivatives are slightly bearish market. At the end of the month, there will be selling pressure as options contracts expire. It will be interesting to see what happens after the holiday. We recommend maintaining your long-term long core position in precious metals. The markets are building solid bases that are attracting new buyers at higher levels. Gold especially should revert back to its real mean. The 360-day cycle for gold, which we published back in September 28th of last year on Seeking Alpha, predicted a target of 2164, which is the VCPMI sell one level on the 360-day cycles. The cycles indicate that this target could be completed sometime in August. That it is the time frame based on the VCPMI annual analysis. Gold is breaking out of a Fibonacci Fend line resistance. We are breaking out of a 50% correction based on Fibonacci analysis. The market should revert back to even to the 2023 level, which is a 78.6% retracement. The previous target was 2112.70, and the target would be 2164. We appear to be building a pattern of gold, in gold, which is very bullish. Use corrections to add to your long-term position in gold.
Are you looking for an automated artificial intelligence trading system? Do you want to analyze commodities and financial markets to determine when to buy and sell? Looking for an indicator to predict future trends in the commodities and financial markets? Welcome to EMA2 Trade Live Signals. Our Variable Changing Price Momentum Indicator, VCPMI, is an automated AI trading system developed and tested over a decade. The VCPMI algorithm is based on age-old vortex mathematics combined with Fibonacci wave theory, trend analysis, pivot points, and several other widely accepted financial analytical methods. The VCPMI can help you take emotions out of your trading and rely on simple mathematics to predict future trends in financial markets. This approach will make your trading more effective, consistent, and profitable. VCPMI algorithm. The VCPMI code points and levels are support and resistance levels and behave exactly like any historical supply and demand level. Therefore, the VCPMI code levels are useful as an index tool for both day trading and for selecting and exercising entries and exits for longer-term traders. Why VCPMI? The VCPMI relies on artificial intelligence to analyze markets and predicts future movements, which seek to determine what a security or commodity is worth at a given point in time. The VCPMI uses technical analysis in the form of mean reversion trading, which seeks to capitalize on extreme changes in the pricing of a particular market based on the assumption that it will revert to its previous state. The VCPMI can be applied to both buying and selling, as it allows a trader to profit on unexpected upswings and save when security or commodity is trading at an abnormal level. Visit ema2trade.com for more details.